Hello and welcome to the parallel economy, where traditional finance meets crypto. But before we dive in, please remember this content is purely for educational purposes and should not be taken as financial advice. Today, we're tackling one of the most fundamental questions in economics. Why does your money lose value over time? Why do prices seem to go up every single year? And why do the savings you worked so hard for lose their purchasing power even when they're just sitting safely in a bank? The simple answer most people give is inflation. But that's not the whole story. The real reason is baked into the very design of the fiat money system itself. Let's break this down clearly and objectively. So, what is fiat money? Really? Unlike the gold-backed currencies of the past, fiat money isn't backed by a physical, scarce asset. Its value comes from the trust we place in the government that issues it. It works because we all agree to accept it as payment, believing that others will do the same. But here's the crucial part. Fiat has a built-in feature that changes everything. It can be created out of thin air. There's no hard limit on its supply. Governments and their central banks can expand the amount of money in circulation whenever they feel it as needed. Sometimes these expansions are small and steady. Other times, especially during a crisis, they can be absolutely massive. Once you truly grasp this one concept, that the supply is unlimited, the rest becomes crystal clear. It's basic supply and demand. If the supply of something grows faster than the demand for it, the value of each individual unit has to fall. This brings us to our next point. Inflation isn't an accident. It's not some unfortunate bug in the system. It's a core feature. Central banks around the world, including the Federal Reserve, openly target a positive inflation rate each year, usually around 2%. Their goal is to make sure your money is constantly, slowly losing its value. But why would they do that? The official reason is that a little bit of inflation encourages people to spend their money rather than hoard it. When people spend, businesses thrive, they hire more workers, and the economy grows. It keeps the wheels of commerce turning. Governments also get a major benefit. Inflation effectively reduces the real value of their massive debts over time, making them easier to pay back. But for you, the individual, inflation acts like a hidden tax. It's a tax that nobody votes on and that requires no new laws. It silently and continuously transfers purchasing power away from everyone holding cash and gives it to those who owe debt. Now, not all inflation is created equal. When new money is printed, it doesn't just magically appear in everyone's bank account at the same time. It enters the economy through very specific channels, usually starting with major banks, large financial institutions, and government contracts. This phenomena is known as the Cantillon Effect. Those who get their hands on the new money first are the biggest winners. They get to spend it or invest it before the broader market has realized that more money exists. They can buy up assets like stocks and real estate at the old, lower prices. By the time that new money trickles down to the general public in the form of wages or stimulus, prices have already started to rise. The cost of groceries, gas, and housing has already gone up. This is one of the key reasons why the value of assets tends to grow much faster than people's salaries, widening the gap between the rich and the poor. Most people think inflation is just a temporary problem, maybe caused by a specific political party or a recent global event. But the truth is much deeper and more structural. Fiat currencies are designed to be inflationary. Think about it. The money supply is programmed to expand continuously. Our entire economic system is built on credit, which means new debts must constantly be created to keep everything running. And to pay the interest on all that existing debt, even more new money has to be created and circulated. Governments also come to rely on inflation to help manage their budget deficits without having to raise taxes directly. Over the long run, looking at decades of data, the trend is undeniable. Almost every single fiat currency in history has trended towards zero purchasing power. Some, like the Venezuelan bolivar or the Zimbabwean dollar, collapse very quickly. Others, like the US dollar, take generations to devalue. But the direction of travel is always the same. Don't just take my word for it. Look at the historical record! Pick any major currency and look at its performance over the last 50 years. Whether it's the US dollar, the euro, the British pound, the Japanese yen, or the Brazilian real, it doesn't matter. Different countries, different cultures, but the exact same pattern emerges. As the money supply goes up, its purchasing power goes down. Official data from the Federal Reserve itself shows that the US dollar has lost over 85% of its buying power since the early 1970s, which is when it was fully disconnected from gold. Other major currencies have followed a very similar path. This isn't a random outcome. It's predictable because it's systemic. So, why does any of this matter to you? Because understanding how fiat devaluation works is the key to making smarter financial decisions for your future. It explains why simply saving cash over the long term is actually a guaranteed losing strategy. Your money might be safe from theft, but it's not safe from devaluation. It also explains why certain assets, like real estate, scarce commodities, and even Bitcoin, tend to behave so differently from cash. They act as a store of value because their supply is more limited. It explains why it feels like your wages can never quite keep up with the rising cost of living. And it explains why the financial system feels so fragile and unstable, especially when money creation goes into overdrive. Devaluation is a slow, creeping process, but its effect over a lifetime is absolutely enormous. This inevitable devaluation is one of the main reasons why alternatives like Bitcoin have gained so much global attention. It was created with a completely opposite design philosophy. While the supply of fiat money is infinite and can be expanded at will, Bitcoin has a fixed hard cap of exactly 21 million units that can ever be created. The Bitcoin Whitepaper was released in 2008, right in the middle of a global financial crisis caused by the existing system, and the network launched in 2009 with a predictable and unchangeable issuance schedule. This built-in scarcity acts as a powerful stabilizing mechanism. Its predictability gives people confidence. People naturally gravitate towards systems that have clear rules that cannot be changed on a whim by a small group of people. Now, this doesn't mean Bitcoin is going to replace fiat money overnight, but it does mean that for the first time in history, we are entering a new era. An era where individuals have a choice. We can now choose the monetary system that best aligns with our personal needs and our long-term goals, instead of being forced to rely on just one. So, to sum it all up, fiat money loses value over time because it is designed to... It's not a flaw. It's the entire point. So, understanding this simple but profound truth doesn't have to be discouraging. Instead, it can give you clarity, a new direction, and a better strategy for navigating the world. Same principles, new rails. If you found this explanation helpful, please subscribe to the channel, hit that like button, and share this episode with someone who might need to hear it. Thanks for watching The Parallel Economy. See you in the next one.